Feds are caught in a trap. This is the Equity Management Academy weekly podcast, mean reversion trading. Summary. The Fed is planning 3 interest rates in 2022, but it may be tough for them to do that given the headwinds the economy faces. Other major central banks are also considering tightening in interest rate hikes. We are seeing an inversion in the yield curve, MontesDeOca said. The Fed appears to be managing the long-term rates to keep them low, while allowing the shorter-term rates to rise. Interest rates. The Fed is planning 3 interest rates in 2022, but it may be tough for them to do that given the headwinds the economy faces. Josh Lipsky of the Atlantic Council Geoeconomic Center said in a recent interview on Yahoo Finance said, that is ambitious, 3 rate hikes. If you look back 30 years, the economy had been accelerating from the previous quarter when rates were hiked, but in 2022, that is not going to be happening, Lipsky said. Hiking rates into a slowdown from the year before is unlikely. They may do the first one, but the next 2 are unlikely. Other major central banks are also considering tightening and interest rate hikes. Lipsky said that any global tightening is going to be fractured with Europe, for example, going much more slowly than the Fed. It's not going to be this unified rebound, Lipsky said. Digital money. Money is going virtual, Lipsky said. 90 central banks representing 94% of the global economy are developing central bank e-currencies. So this is not just Bitcoin. It's a central bank thing. How people interact with banks and the government is going to change. WeChat is now supporting the digital yuan, which has 900 million users, 10% of Chinese citizens. Now that digital yuan WeChat wallets. However, it is a domestic-only product and can only be used in China. A big question is whether foreigners can use the digital yuan, and if so, can they take it home? The digital yuan represents a threat to foreign companies in China since if the government dislikes something they do, the Chinese can block all payments to that company or hold their assets hostage. 10-year note. Patrick MontesDeOca, CEO of the Equity Management Academy, said that interest rates appear to be moving higher with a 10-year note trading above 180, up about 2.2%. We are seeing a fairly sharp increase in interest rates, MontesDeOca said. The low was 0.32 in 2021. Technically, the market appears to be putting a major double bottom on the 10-year note. The 10-year bond is at 2.14. The lowest yield in the past year was 0.70 on January the 3rd, 2020. We are seeing an inversion in the yield curve, MontesDeOca said. Particularly in the past few weeks, the 10-year note has moved faster than the 30-year bond rate. So the cost of money on the 10-year is going up faster than the 30-year. The Fed appears to be managing the long-term rates to keep them low, while allowing the shorter-term rates to rise. The Feds are tapering about $30 billion a month until March. The key is how fast interest rates are going to go up. Demand for goods and services continue to be very strong, but Omicron, which may be the end of this pandemic, is causing major numbers of hospitalizations. People are not going out as much, vaccinations are required, but there is resistance to requiring vaccination to work or to go out. The shortages of supplies and goods appear to be continuing. Prices continue to rise, and it appears for a range of reasons. People are starting to spend less, which is not good for the economy. Crude oil is at $80 a barrel, which is also not good for the economy. It seems similar to when the Fed raised rates in 2016-17, which was the bottom of the gold market. If the Fed raises rates a quarter point this year, we could see gold respond in the same way in 2016-17. The Fed then decided, since the markets had a tantrum, to reduce interest rates again. The Fed then moved rates down aggressively to negative rates. More recently, as the Fed has pursued massive stimulus, gold made a low in April 2020 at 1267, and then rallied up to 1704, retreated again, and rallied again above 2089 in 2020. It then went down to 1673 on March 8, 2021, and it appears to be matching Fibonacci retracements and technical predictions. Since March 2020, the bottom, gold rallied up from May 14 to May 24, 2021. The low established a major bottom for a big uptrend. On September 27, 2021, the seasonal low was made at 1721. From that low, the market has been trading in this major uptrend channel. We are reverting again from another low, and it looks like it could rally to the upper end of the uptrend channel above $2,000. For the weekly variable changing price momentum indicator, the VCPI numbers, daily average is in a bullish price momentum within a weekly bearish price momentum. Gold is around the average price, so we do not trade around the average price. We wait for the market to go to an extreme above or below the average to trade, where the probabilities are much higher than the market will revert to the mean. 1786 is the daily buy one level just below the market. It is a level of support. From that level, there is a 90% probability of a reversion back up to the mean. The targets we have this week to take profits on our swing position or trades are at 1826 and 1855. We are prepared to add to our long position at 1774 to 1752, or to get on the long side.
Thank you for listening. If you want to learn more about what we do, please go to the Equity Management Academy, EMA2trade.com, or listen to any of our previous episodes.